Hi everyone, this is Anna Thornburg with Model Wealth, and in this video I am going to be discussing market risk and reward. Many of you might already be familiar with this fundamental investment concept, so hopefully if that's the case, this is a helpful review or potentially even a helpful resource to share with someone in your life who might be newer to these concepts. If you are an existing client of Model Wealth, then the resource in front of you probably looks quite familiar. This table is one that we borrow from Vanguard quite often to explain the concept of market risk and reward. Reading this summary statement here at the top, it's important to have realistic expectations about the trade-offs between risk and reward. A balanced, diversified portfolio can help reduce portfolio volatility. This table shows long-term average annual returns for various asset allocations between U.S. stocks and bonds and the performance of those allocations during select equity bear and bull markets. So said another way, it's important to understand that with the potential for reward also comes the potential for risk. In other words, if you have an investment that grows in its value, then it also will lose value at times. Having a balanced and diversified portfolio, so a portfolio that invests in more than one thing, can help to reduce the portfolio volatility, or how quickly and how frequently those values will change. This table uses historical data to support that concept and also to illustrate how different allocations will have changed value, or did change value, I should say, during different bear markets in U.S. history. So to review, here on the left side, you can see that it shows the asset allocations going all the way from 100% bonds to 100% stock and various allocations in between those two. And then it also displays the performance of 100% cash portfolio as a sort of baseline to refer to. Along the top, you can see an average annual return for those various allocations. That's what this is labeled. And this is for the years 1926 to 2023. So before the Great Depression to very close to present day. And this takes the average annual return. In other words, the annual return of all of those years and then the average of those. The inflation adjusted average annual return is that same measurement, except it takes into account the rising cost of stuff. In other words, inflation, like it says. The number of years with a loss between 1926 and 2023. And then the cumulative returns during 4 different bear markets. So in other words, it shows this period of 1973 to 1974. These are 3 different market crashes, I should say. The cumulative return of the tech crash in 2000 to 2002, the housing crash 2007 to 2009, and then this most recent market downturn, market crash that happened in 2021 to 2022, which is probably a fresh memory for many of you, many of us. So how can this apply to an actual situation? Let's imagine that your money is sitting in cash. What can you expect on a regular year for the return to look like? The average annual return of your money sitting in cash is going to be 3.32%. However, when we take inflation into account, that doesn't look quite so good, and it moves down to 0.37%, which essentially means it's keeping pace with the cost of the things that you will buy with that money. I also do want to point out, I also do want to point out that in this graph, it is using the benchmark of treasury bills. So we are not referring to paper money or the money that you would have sitting in your checking account. We're referring to money that's invested in something that is like a cash-like investment. So treasury bills, a good money market account, a high-yield online savings account, those sorts of things. Of course, money that is just sitting in a checking account should only be transactional because it will actually lose value over time. So it's important, obviously, to keep the money that you need for everyday expenses in cash. However, let's assume that you have enough money to cover short-term needs, so you might be willing to take on a little bit more risk in exchange for growth of that money, or potential reward, put another way. So let's imagine that instead of just having your money in the bank, you decide to essentially become the bank by opening an investment account and investing it 100% in bonds. In that case, the average annual return with inflation considered is going to be right around 2%, which is, of course, not a high return, but better than cash. And the number of years with a loss is only 17 out of the 98. So it's not going to be as risky as certain more aggressive or more heavily stock allocations. One thing I do want to point out is that if you add in even 10 or 20% of stocks, the number of years with a loss goes down from 17 to 13 and 14% respectively. This is an illustration of how diversification works. Even though stocks are generally more volatile than bonds, if you add in even just a little bit of diversification into the portfolio, then there are certain years when maybe bonds are not performing well, but stocks are. So your portfolio as a whole is still going up, and vice versa. So this is obviously a clear example of how diversification works. Oops, I jumped ahead. All right, so assuming that you are okay with the level of risk in bonds, but you would like to make more, you would like to have more growth, let's imagine that instead you're considering a 100% stock allocation. In contrast with this 2% inflation-adjusted annual return, you have an inflation-adjusted annual return of 7.19%. That is a lot higher. So your money is going to be growing a lot more over time. However, the number of years with a loss, so the number of years that you will see that number going down instead of going up, is 27 out of 98 instead of 17. So that is about a third of those years. You will look at your statement and see that it is lower at the end than it was at the beginning, which is going to feel pretty uncomfortable to a lot of people. However, so like I said, with this potential for growth of this higher average annual return comes the potential for losses very regularly, pretty frequently, and maybe somewhat unpredictably. This isn't surprising when we take into account what stock ownership actually is, which is essentially that you are owning a small piece of a business. So individual stocks, perhaps, of companies like Apple or P&G or Nvidia, or as we generally recommend at Model Wealth, mutual funds or ETFs that include small pieces of thousands of companies. As we know, business ownership and companies in general have the potential for significant profit. They can gain a lot of value. However, a lot of them fail, a lot of them have bad years, those sorts of things. So the profit or the growth from those investments is going to be very much up and down. Let's assign some actual numbers to this scenario because sometimes it can be hard with just percentages to know how that translates to the actual portfolio value. So let's just assume that you have an investment portfolio of $1.25 million, for instance. In 100% bonds, that 5% average annual return is going to look like your 1.25 growing by $63,000. In these down years, this is what your overall value will look like. So on average, you're going to move from the 1.25 to 1,300,000 and change. And then, but unfortunately, in certain crashes, it's going to go down by a relatively significant amount. Obviously, $100,000 is a lot of money, but in proportion to the rest of the account, it's, it's not a half. It's not half, for instance. However, for also in certain market crashes, you actually will see a gain in value. So this is interesting to observe because ultimately the bond market and bonds in general do not necessarily track the performance of the stock market as a whole. Their relationship between the stock market as a whole and inflation and those other factors is pretty complex, which is part of the reason why having them diversifying a portfolio can be beneficial. Jumping to our 100% stock example, you can see that the average annual return, and this is not inflation adjusted, I just want to point that out, the average annual return is about twice as much as the 100% bond portfolio. However, we look at the effects of the crashes, These numbers are significantly larger for the most part, and they're all negative. There's no mix of negative and positive here. There's always, there's a loss in every one of these scenarios. And in some of these situations, for instance, in 2007 to 2009, your $1.25 million portfolio would fall all the way to right around $700,000 in both of these instances. So that's almost in half. So this is relevant because ultimately, if you are actually living through these scenarios, this is going to cause you potentially a lot of stress. So this is part of the reason why we don't necessarily encourage checking portfolio balances constantly and that sort of thing. However, we're only human and we like to maintain an awareness of these things, of course. So if you are checking routinely in these market downturns or during these market crashes, it's going to be a potentially stressful situation, and hopefully not, but potentially you could feel an urge to sell out of the market and say, you know what, I think the market is too risky for my taste. This doesn't feel good. I don't want this to ever happen again. I'm going to get out of the market. And ultimately, not only is that exactly the wrong time to get out of the market, but also we can see historically that over time, not on a week to week, month to month, or even over the course of 1 year, does the stock market always grow. But over a long period of time, the stock market does go up. So even if you suffer these massive losses, your portfolios do recover. The market does recover. So if you are able to stay the course, then you will see the benefit in the long term, if not necessarily in the short term. However, if you want a bit more of a moderate approach, let's take a look at a 50-50 allocation. So as you can see, the average annual return basically splits the difference of the other two. And then the cumulative returns during these market crashes are still negative. There's still significant amounts of money, of course, because any percentage of a loss in a portfolio that large is going to be a large number. You're going to see a large number. These are hundreds of thousands of dollars. However, it's a lot more moderate than the previous example. You don't see any of these numbers that are almost half of the portfolio. Most of them are hovering, except for the average growth, obviously. Most of these losses are hovering at still the portfolio is worth right around $1 million, which you can, I think, understand conceptually how that's going to recover a little bit more than when you see it go down by such a substantial amount. So generally, it's going to be a lot less volatile or extreme in changes than stock alone. I do want to point out that the same thing that is true of losses in value is also true of growth in value. That means that in your stock portfolio, on certain good days in the market, you are going to see a massive increase in growth. And in a more balanced portfolio, those increases are not going to be as large. It's going to be a bit more of a steady ride over time. So there's not going to be as extreme peaks and valleys in what you're seeing with your portfolio, which, depending on your long-term goals, your time horizon, your own personal temperament, one of those may be a better choice than the other. This is certainly not to say that a balanced or 50-50, 60-40, 40-60, what have you, that allocation is the best choice for everyone. That's certainly not the case. Ultimately, there are a lot of factors that will affect your specific allocation that you should choose. However, it's basically just to say that you should not be blinded by the potential for upside of a heavy stock allocation and putting all of your money or putting all of your eggs in one basket, but also not be scared off by the risks of what bad days look like either. It's interesting to think about how much history is covered in, for instance, this 98-year span of time. Like I mentioned, the Great Depression happened during that time period. World War II happened during that time period. People are starting to use cars during that time period, and airplanes, and the internet is invented, and all of these different things, massive political changes globally and in our country. And ultimately, a lot of those changes for certain individuals could have felt either world-ending and catastrophic or life-changing in an amazing way. But ultimately, when you look at overall market trends, it's continuing to steadily go up, regardless of those specific events that might seem like essentially the end of the world. So depending on your general mindset or personality, you might find it a little bit easier to focus on potential for upside or potential for downside. I myself tend to be a little bit more of a worrier, but you might be more of a risk taker naturally. And ultimately, those things can affect and should affect the allocation decisions that we make. But ultimately, it is about staying the course, having a plan that makes sense for your goals, your time frame, your specific situation, all of those things, and sticking with it even when inevitably things go up and down in the market. So hopefully this is helpful. If you have any questions, please don't hesitate to contact any of us at Model Wealth. Thank you so much for watching. Have a great day. Bye-bye.